market? Join us for another episode of FDM Brews to learn more about trends and updates in the mortgage industry that can help you get your clients pre-approved for the home of their dreams.
Good morning, Brett.
Good morning, Cindy. It's another beautiful morning.
Time to caffeinate.
Absolutely.
Time to get jazzed up.
I'm about 3 in already, so I'm pretty wired.
Well, you get up way earlier than the rest of us, so I applaud that, and I'm sure you are heavily invested in the future stocks of caffeine here.
Absolutely.
Well, today we have an interesting topic. Well, interesting, and it can be depressing, but you know, the thing that has been plaguing the news lately is just really these banking crises, right? And I just, as a layperson, right, I don't really understand where all of this is coming from and what the impacts are. And, I was hoping that since you're such a smart guy in the mortgage industry, that you could explain it in a way that I can understand and that all of our agents can really understand what caused this, and what it means for our future and how we can really, help our clients overcome any of these issues that are going to come up from the banking crisis.
Well, Cindy, you're certainly right. It is on top of the news. We've been dealing with this really since the end of last year. We hear about the banking crisis, and I get questions all the time. Are we reliving 2008, 2009, and 2010 when we had the most recent banking crisis? Right now, I've been through 4 of these because I'm a little older than everybody. But, they tend to pop up every now and then. And, it's really become a headline issue when you see the failure of SVB, Signature, and then most recently First Republic Bank. What's happening? Well, we all know in our daily lives that interest rates have dramatically increased over the last 14 months. In fact, the Fed has been on a consecutive 14 straight months of increasing interest rates. We've gone increased interest rates about 500 basis points within a 14-month time period. Well, it doesn't take a lot to figure out that that's really a shock to the system. So what happened, and what does that mean to us? So not to get too technical, because I tend to do that sometimes. I don't want to do that today, but the challenge that you had, whether it's SVB or Signature or even First Republic, the bank was not managed right. Well, they're facing the challenges of a rapidly escalating interest rate environment. We all look at it and say, man, for my homeowner, or my home buying client, I was looking at interest rates in the 3s. Now I'm looking at interest rates in the 7s. Well, my home buyer can't do that. Well, banks are facing the same issues. So what happened? When interest rates were very, very low, when a bank takes your money in as a depositor, you go in and you put in your direct deposit, your check, the bank gets it. They're not keeping all that money in the vault behind them, right? How banking works is they take that money in and they pay you a whopping 0.5% or something like that. And then they make investments. And those investments are loans, but they also invest in things like mortgage-backed securities or treasuries. And honestly, the government was pushing a lot of banks to invest in treasuries because you have to fund the debt ceiling now is a topic of discussion, right? But the Fed, the government, borrows money in the form of treasury bonds. So banks were buying these treasuries. Now they're buying them in what's called yield to maturity. So a bank says, I'm going to buy this 10-year treasury bill, which is guaranteed by the government, which means I'm always going to get paid back. And I'm going to get a 2% yield, but it's a safe yield, right? I know that I'm going to get that payment with that treasury bond. Here's what happened is they invest in all these because, quote, they're safe investments. They're backed by the government. I'm going to get a 2% yield. That's great. Interest rates are very low. I'm only paying Cindy a whopping 25 basis points or 0.25%, maybe even 0 on her checking account. So I'm making money. Well, what happened? Interest rates skyrocketed, right? So all of a sudden, that 2% yield is a problem. Now, you combine that, Cindy, with inflationary pressures now. Instead of putting money into the bank all the time, what are clients doing? They're taking money out of the bank. And since the bank doesn't have that in their vault, what do they have to do? They look at it and say, okay, well, now I've got to go sell those securities that I was planning to hold on till and just get that 2%. But I have to go sell them in a market that's now 5%. Well, an investor goes, wait a minute, the market's 5% today, not 2%. So if I'm going to buy a 2% treasury, I'm going to buy it at a really steep discount. So the bank has to sell that to get the money to give to their depositors, but they're selling it at huge losses. And it creates a snowball. And that's what happened with SVB or Signature Bank or even First Republic. People were taking money out. They had to sell those investments to get that capital to give to their client. Because the market moved away with that 500 basis point swing, they were selling them losses. And as they sold losses, right, in publicly traded companies, they report their earnings. Wait a minute. The client says, wait, I got my money in Signature Bank, and I just saw they lost 100 million last quarter. Get my money out. Get my money out. So it creates a snowball that you can't recover from. And it just keeps getting bigger and bigger and bigger. That's what we saw happen. The worst part about it, Cindy, is it's probably not over. Right? Interest rates continue to go up. The Fed just talked about that last week. They raised interest rates again. Now, they did say they might pause, but they didn't say they're going to pause it. They're going to look at inflationary data. So what's going to happen is, as banks need to liquidate these assets to give money back to their depositors, they're going to create losses. And that's why you hear that quote, contagion, right? Are we going to see the same thing we saw in 2008? Yeah. What concerns me, Cindy, is the German regulators on Monday said that their banking system is under stress. So we're seeing that now spread into the European banks as well. I don't think this is a repeat of 2008, but there is concerns there in the banking sector.
That's a lot to handle. And now, so we've got the multiple influences, and the banks are tightening up and they're facing losses. And how is that going to impact your buyer that's trying to get a mortgage on a home?
Well, I think what we're seeing, Cindy, and we actually recognized this trend a while ago. So what do banks have to do in face of this challenge, right? They have investments at 2%. Interest rates now are 5-6%. Those investments aren't as valuable, but their clients are going to want their money. When you go in and you want your money, you want your money. So what are banks going to have to do? Banks are going to have to protect their, quote, balance sheet and liquidity. And how are they going to do that? Well, they're going to pull back on lending. We've already seen that. Actually, if you look at the Fed minutes on the newsletter I put out, they said, quote, we will see a tightening of the credit cycle in banks. And why is that happening? Well, because I can't put the money out, right, if I need to give it to my client. So what are they doing? They're pulling back product. They're making it more difficult. They're, quote, as the Fed said, tightening the credit cycle, which means it's going to be more difficult from an underwriting standpoint. Banks will need to do that because they have to create liquidity for clients that need their money. And they can't sell these big losses, these other investments at losses. So they're just going to hold on to liquidity, which means they're going to lend less.
Mm-hmm. So if they're lending less, where are people going to find the resources? Like how can we keep the potential buyers, on the market and help them get access to the funds they need?
So what you're going to see, Cindy, and we actually recognized, it's funny, since if you looked at the top 10 mortgage lenders in 2010, right, at the tail end of the most recent banking crisis, right, when you look at the top 10, the majority of them were banks, right? It was Bank of America, it was Chase, it was Citibank, it was BB&T, right? Wells Fargo, all of those were the major players. Fast forward to 2022, the year that just ended. How many banks were in the top 10 mortgage banking lenders at the end of 22? What do you think? Take a guess.
What, 3?
None. So what's happened, right? There was a very important law called the Dodd-Frank law, right? And that was kind of to reform banking process after the crash of 2008. So what happened is banks started to trend away from the mortgage banking business. Now, in the non-agency market, they were a big player, but we've seen that transition to what we would call non-depository independent mortgage bankers, which is what Fidelity Direct is, right? We deal with Fannie Mae and Freddie Mac and FHA. So what you're going to see is that trend now is going to continue. As banks pull back, we're going to see independent mortgage bankers like Fidelity step in and fill the vacuum. So that trend that started in 2010 is probably going to accelerate more as we look into the end of 23 and to 2024. Where it becomes a challenge is in what we would call the non-agency market or the non-conforming market, which are jumbo loans, right? So when you're looking over the agency limits, you're looking at jumbo loans or specialty products. What we're going to see is banks are going to be in that space, but it's going to be a little more difficult to get a loan. You're going to need a higher credit score. You may need to put more money down. They're not going to be as flexible as they were in the past because they're trying to retain that liquidity. So in certain markets like Southern Florida, where you're looking at higher end products, you're going to see that, and that might put a little bit of a challenge, if you will, in that segment. So we'll step up and fill the void, and we're dealing with folks on Wall Street, so we have opportunities to do that. But you're going to see that trend away. You're going to see banks continue to pull back, and independent mortgage bankers that are working with agency product rush in to fill the void.
Interesting. We're here in May 2023, and typically the real estate cycle in Southwest Florida, it drops over the summer and
Right.
then it picks back up in the fall. So I'm going to ask you to pull out a crystal ball and look like 6 months from now and say, whew, like what, if we're going into the market and we've got buyers coming in, more in the fall, what can we do to prepare now so that our buyers in the fall can really be able to jump on the properties that they find?
Well, I think, Cindy, it's two things, right? Depending on what price point they're looking at, right? If you're looking in the product that would be what a conforming product would be, which would be within Fannie Mae or Freddie Mac limits, right? You're working with an independent that's going to be committed to the mortgage industry and make sure that, that's who you're working with. And if you have a bank pre-approval, I would say it's very prudent to get a backup, because we've seen it now, right? Wells Fargo or Flagstar, for example, just pull out of retail mortgage banking right away. Okay, well, if my client was working with them and they have a pre-approval and they're out of that space, what am I going to do? So I think it's prudent to have a backup with an independent just in case that happens, right? Or have somebody pre-approve your buyer just in case that bank decides to exit that space in the time that you had them pre-approved and the time that they find a property. I think that's really prudent to do that. When you're looking at, say, maybe the jumbo or super jumbo space, let's work with our clients to say, okay, we know these are the trends that are happening, is that credit score requirements are increasing. So let's sit down with you and find out where you are today and what would we need to do to get your credit score above. Maybe, right now, a 720, which is a great credit score, finding a jumbo loan under 720 now is very difficult. So even 700, which is a great credit score, might not be enough to get you a jumbo loan that you're looking for. So what do we need to do to get you over that, right? Same thing with, they might require a larger down payment. So what's the liquidity we have? So getting ahead of those things early, if it's going to pause in the summertime and that September, October, November time period is picking up in Southern Florida, what do we need to do over the next 3 months to put you in a position that you're ready to buy? Because I do think in that jumbo space, we're going to continue to see the tightening of credit. I mean, it's all over the news. When it's in the Fed minutes, when they're talking, hey, this is what we expect. What's really interesting, Cindy, when you read the minutes, right? And it's everybody pays attention to the headline. The headline is, did the Fed raise rates or did they not raise rates? And that was kind of my comments in the newsletter last week was, but the devil, as they say, is in the details. And the details are, what is their outlook for the economy? And what is their stance going to be? So, as I said, 14 consecutive rate increases for the Fed, 500 basis points increase in rates. That's a shock to the system. Yeah. Now, what they said was, and this is good and bad, what they said was very clearly that Fed Chair Powell said, hey, we expect banks to tighten credit availability. Okay, that line was clearly in there. What they also said is, and this is the good and the bad, if banks tighten credit availability, is that going to slow the economy? And if that slows the economy, we can lower rates. So wait a minute. They're not going to lend any money, which is great, but that's going to slow things down. And then we'll lower rates, right? Which raising the rates is what caused the problem in the first place. So a lot of these things you look at and you go, really? That's what you just said, right? We think banks are going to tighten credit, and that may have a material negative impact on the economy, which will allow us to pause raising rates. Okay, that's the good and the bad. Rates are going to get lower, but they're going to get lower because banks are going to lend any money, right? So those are some of the special challenges we're dealing with. And I think they really have to do that because they don't want to see a repeat. I mean, for those of us that have been in the business for a while, 2008, 2009, 2010 were ugly. They're really concerned about the, quote, contagion, and is this spreading to other banks? So I think that's really a headliner for the Fed. They're really looking at that. So their monetary policy is going to be to try to make sure that that doesn't happen. I think one of the warning shots, if you will, was the German regulator saying, look, we're seeing that spread and stress in the banking system in Europe. That certainly would make banks here a little bit nervous. So it's just something that we're going to have to work through. Oh, we had a power hit. Sorry about that.
Oh, the banking crisis.
The
It's
banking crisis, we had a power hit. We got storms
getting it.
going on here. I just heard a crack and a boom and a power hit. So sorry about that.
That's okay. That's okay. This has been a really valuable conversation. And I think, at the end of the day, one thing that I've learned from you that really hits, hits me hard is like, at the end of the day, investing in real estate always grows, right? Like that's
It
the best
does.
and the safest investment you can make. So,
What's really important, Cindy, and I think from a financial perspective, you're 100% right? It's not cryptocurrency. It's not the stock market. It's not even your 401k. The first investment everybody should make is real estate, right?
Yeah.
Because you have to pay to live somewhere, right? So that's the best return of investment that you can get. The other part is, when you're looking at tangible assets, and this is funny, when people worried about inflation, they said, okay, we're going to go to gold or we're going to go to this. Okay, those are fixed assets, hard assets. So is real estate. And what I can tell people is this, and if you look at 1970s, which yes, I bought my first house in the 70s, 80s, 90s, right, all the way through to even when we had what I would call cyclical downturns, and we've had them in every decade, right? I lived through the savings and loan crisis where we had a downturn. I lived through the Russian debt crisis where we had a downturn. I lived through the last banking crisis where we had a downturn, and we've seen prices normalize here. But the fundamental thing is, over time, real estate always does what?
it
Goes
always
back up.
goes back up for sure.
Everybody that panicked and sold their house, because I used to have clients, oh, we're underwater, I'm going to sell my house. Everybody's okay. Every single person that sold their house in 2010 wishes in 2020 they kept it, right? And now during that time period, they may have seen properties values dip just a little bit, but they came back up, right? And I used to tell clients, and they used to go, I don't understand. Everybody's telling me I should walk away, quote, strategic default because I'm underwater and never recover. I'm like, look, let me see. You're going to sell your house at a loss. Or you're going to walk away and let it go to foreclosure. You're going to pay somebody rent, right? So they get the value and the house is going to go up in value. And one of the things that I always use this story, Cindy, and maybe we can end with this, is that, I'm fortunate enough in my career, I dealt with the Bear Stearns and the Shearsons and all those guys and the Goldman Sachs. And during the crisis, they were saying mortgage and real estate wasn't worth anything. So when their firms closed, they went to Fortress and Citadel and BlackRock and started buying all the real estate. So wait a minute, when you were sitting in this chair, you were telling me it wasn't worth anything. But you moved down the street and sat in that chair and you started buying all the real estate, right? So always follow the smart money. When they started buying real estate, when you think about this, at the type of the crisis, BlackRock bought 17,000 investment properties, right? When we look at home buyers having struggles trying to get inventory, it's not because they're competing against you and I to buy the house. They're competing against BlackRock, Fortress, Citadel, who are also buying real estate. Why? Because they see it as a good investment. If you read their investment perspective, BlackRock, Citadel, Fortress, they are still investing in residential real estate. And that's what our clients should do as well.
Absolutely. Well, you always leave me more informed and inspired. So cheers, my friend.
Cheers. It was great. Great. Awesome. Thank you again. It's always a pleasure.
Absolutely. All right, folks, check the phone number and the email on the closing screen. Always reach out to Fidelity Direct Mortgage. They're happy to help you and help your clients. So thank you so much. We'll see you next time.
Thanks, Cindy.
Thank you for joining us for FDM Brews. Our team is here to answer your questions. Just call 239-359-6590 or email us at dfry@fdmhome.com.